Welcome to this explainer. When we're tapping away on our smartphones, streaming movies, or messing around with generative AI, it's so easy to just marvel at the software and the hardware, right? But today, we're doing something a little different. We're going to demystify the invisible financial engine, the limited partnership model that literally built the modern digital world. It's the underlying blueprint that made all of these wild physical and digital innovations possible.
So here's our blueprint for today. We're going to cover 1. The corporate financial chasm, 2. The power law inversion, 3. Anatomy of the machine, 4. The funnel of attrition, 5. The venture operating system, and finally, 6. Funding the AI future. Let's dive right in.
Part 1. The corporate financial chasm.
Okay, picture the traditional banking model, what we can call the Wall Street silo. Back in the day, if pioneers like Arthur Rock or Don Valentine walked into a bank for a loan, the credit committee wanted touchable, hard collateral. We're talking factories, gold reserves, decades of historical balance sheets. Now, contrast that with the mid-20th century out on the San Francisco Peninsula. You had these brilliant engineers, right? But they had absolutely zero physical collateral, no cash flow. Their entire worth was locked up in pure abstract intellect and, molecular physics. To traditional Wall Street, backing these guys wasn't investing. It was straight-up institutional madness. They needed a completely new kind of financial bridge to cross this massive chasm.
Which brings us to Part 2, the power law inversion. To bridge that gap, these financial engineers had to totally rewrite the mathematical rules of risk. See, traditional finance protects the mean. It operates on a Gaussian normal distribution, basically your standard bell curve, where most outcomes cluster safely right in the middle. Why? Because in traditional banking, one good stock pick mathematically cannot make up for 50 bankruptcies, so they obsess over downside protection. But venture capital? It operates in a power law distribution. In this world, the average is completely meaningless. The genius here was realizing that your downside on any single bet is strictly capped at 1 times your money. You literally can only lose what you put in. But the upside? Well, it's theoretically infinite. It could be 10 times, 100 times, or even 10,000 times your initial investment.
And that brings up a pretty wild point. This new financial operating system was explicitly engineered to tolerate an 80% baseline operational failure rate. 80%. I mean, think about that for a second. In what other industry on Earth could you intentionally design a system where you fully expect 8 out of 10 of your projects to end in complete, absolute failure? But here, massive failure isn't a bug. It's a feature of discovery. In the innovation economy, if you're constantly looking for downside protection, you're pretty much guaranteeing mediocre returns. The true objective isn't to minimize how often you fail, it's to maximize the absolute magnitude of your success.
So let's look at Part 3, Anatomy of the Machine.
If a venture fund operated like a standard mutual fund, investors would absolutely panic at the first sign of failure. They'd demand their money back, force fire sales, and basically kill off innovations long before they could mature. The brilliant fix for this? The 10-year closed-end limited partnership. It acts like a vault. The limited partners, these are your universities, your massive pension funds. They hand over their capital and are legally locked out for a decade. No voting rights, zero early redemptions. They become completely silent. In return, the general partners, the venture capitalists themselves, get 10 years of total uncompromised autonomy to steer all that cash right into the speculative unknown.
And driving this whole thing is what's known as the 2 and 20 loop. This fee structure practically institutionalized a militaristic focus on building monopolies. The 2% management fee, honestly, that's just to keep the lights on, paying for those low-slung offices on Sandhill Road and covering the scouting trips. But the 20% carried interest, that is where the true alignment happens. General partners get zero financial reward if a company just merely survives or offers, slow, linear growth. They only get that massive 20% cut of the profits if they engineer a colossal exit like an IPO or a massive corporate buyout. It's a structure that literally forces the VC to reject safe bets and continuously swing for the absolute fences.
Part 4, the funnel of attrition.
So instead of just hoping for a lucky break, this machine actively forces success through a super disciplined, multi-stage process. It completely strips away any corporate sentimentality. Failure is just treated as a totally standardized cost of gathering information. Step 1 is the seed stage ingestion. They take in raw ideas, maybe looking at 3,000 pitches just to fund 30 cheap prototypes. Step 2, right around years 4 through 7, is the Darwinian shift. As these prototypes try to become actual businesses and inevitably hit structural walls, the capital is ruthlessly cut off. The asset is written down to zero without a second thought. Then finally, step 3, nearing the end of that 10-year decade, they take massive reserve capital and violently concentrate it behind the tiny fraction of proven, market-dominating winners.
Just look at how the math actually plays out in a standard 50-company ledger. 30 of those companies suffered total asset death, just complete write-offs. Another 15 become what they call the living dead. They survive, maybe pay their bills, even return the initial capital, but they don't really scale. Statistically, they're zeros. But those remaining 5 parabolic winners, they generate 20, 50, or even over 100 times the initial investment. A single 100x home run completely wipes out the cash losses of all those initial dead positions. The mathematical beauty of the machine is that structurally destroying the vast majority of the portfolio is completely irrelevant as long as you secure those extreme outliers.
Part 5. The Venture Operating System. So, how exactly do they scale these super fragile companies from literal garages to global industrial giants so incredibly fast? Because, let's be real, giving a brilliant software engineer $1 million doesn't just magically turn them into a CEO capable of navigating global patent law or building out a massive worldwide sales infrastructure.
The answer is they built an entire administrative scaffolding, a literal operating system for company creation. First, you had high-tech law firms acting as legal conduits, basically doing corporate formations for free in exchange for deferred fees and equity options. Second, a specialized executive recruitment matrix. They'd poach battle-tested executives from mature giants like Intel or Apple and drop them straight into these chaotic startups to stabilize them. And third, a wealth recycling loop. When a startup finally went public, that immense flood of Wall Street cash didn't just flow back to New York, it stayed local. The newly rich founders became the next generation of angel investors, directly funding the next wave of disruption. The sheer speed of this ecosystem was just unmatched.
Which brings us to our final section, Part 6, Funding the AI Future.
Now, let's connect this 1970s architecture directly to what's happening right now. While the aesthetics have totally shifted from hand-wired microchips to layered neural transformers, the underlying financial highway hasn't changed a bit. Back in 1972, this machine was built to fund silicon transistors. Fast forward to the 1990s, and that exact same machine funded the internet supernova, backing giants like Amazon and Google. Heck, a single early check to Google effectively paid for every failed .com startup 1,000 times over. And today, we are seeing the exact same thing with the massive AI infrastructure wave in San Francisco's so-called Cerebral Valley. When a modern VC writes a $100 million check to a group of engineers who have nothing but an unproven neural network training hypothesis, they are running the exact same asymmetric power law calculation invented over 50 years ago.
There's a great quote that says, "They broke the ancient tyranny of physical capital, proving that the ultimate wealth of a civilization belongs to those who possess the raw institutional audacity to treat physical assets as a commodity and human intellect as the sovereign master of reality." So I want to leave you with this provocative thought. As we watch AI fundamentally reshape human existence right before our eyes, who really holds the power here? Is it the developers writing the code, or is it the architects of the extreme risk machine funding them? The code running the world today is traveling on a financial highway paved decades ago by pioneers willing to treat failure as just another line item cost. They built an enduring crucible of risk, and that machine, it's still running at full throttle. Thanks for joining me on this explainer. Keep questioning the architectures around you, and I'll catch you on the next one.